Well, good morning and welcome to the Global View on this Tuesday morning. I'm Nadine Blaney and it's a pleasure to be here with you. So the S&P ASX 200 is expected to dip as it opens even after a record-breaking night on Wall Street. The Nasdaq hit a record high. The S&P 500 also gained and the Dow was up by 0.25%. So we saw Nvidia and Microsoft higher in New York. Broadcom continued its rally as well, up another 3% on AI-related revenue growth expectations. Tesla shares fell, though, on a report that its U.S. EV market share dropped to an 8-year low in August. The S&P's top three performers, Take-Two Interactive Software, Live Nation Entertainment, and Uber, on plans to launch self-driving testing in March. Bigger picture, gold miners rose as the precious metal topped 3,600 for the first time. And continuing in commodities, Albemarle shares rose after the Bank of America lifted its price target on the stock as lithium prices show signs of life. And after the bell, shares of Fox and News Corp fell. So that, of course, represents what happened during the session after Rupert Murdoch agreed to sell billions in shares and give them to three of his children in exchange for Lachlan Murdoch retaining control. 16.9 million shares will be sold and News Corp will launch a secondary offering of 14.2 million shares. Fox says the succession resolution, if you can call it that, will result in the termination of all litigation. Well, expectations for a Fed rate cut continued to drive that sentiment on Wall Street. The rate futures market sees zero chance that the Fed will stay on hold after next week's two-day meeting. The latest read shows a 90% chance of a 25 basis point cut and a 10% chance of a 50 basis point cut. Now, leading into this week's key inflation data, the New York Fed's one-year inflation expectations survey rose to 3.2%. The three-year ahead measure was unchanged at 3%. Also, a New York Fed survey showed a notable rise in concerns that Americans have about their ability to get new employment in the face of a job loss. In politics, the French Prime Minister resigned after losing a confidence vote. President Macron will either name a new Prime Minister or call for new elections. This will be the third change in government in a little over a year and the fifth in 20 months. So that political uncertainty in France, Japan, and Argentina, as well as Indonesia, dominated currencies, with the US dollar extending its losses and the Aussie dollar trading at 66 US as we speak. In U.S. Treasuries, yields fell for the fourth straight day to their lowest level since April. The benchmark U.S. 10-year yield is sitting at 4.04%. Bitcoin traded higher on expectations of a Fed cut, and you can see it there currently up by close to 1%. Oil lifted overnight, recovering some losses after OPEC Plus opted for a more modest output hike and as traders price in the possibility of more Russian sanctions. And as flagged, gold rallied, settling at $3,677.40 on futures markets. Copper edged higher on a weaker US dollar and lower copper stocks. And iron ore futures rose for a fifth straight session on lower shipments and strong China steel export data. So for more on global markets, I caught up with Elfreda Jonker from Alphinity Investment Management earlier, and we began by talking about rates.
I have to tell you that we don't really try and make interest rate, calls. We're not economists, but definitely from a overarching perspective, if you look at the data points that we have been receiving, the softness in the labour market, the market is definitely going for that 25. I think that's pretty much 100% priced in now, and around a 10% chance of a 50 pip cut. I think that would probably be quite aggressive, just seeing where the Fed has been coming from. And I think we are still moving, sort of walking a tightrope here between the potential that you could see inflation still surprising to the upside. And if you start to cut too early, you can really cause that scary word called stagflation.
Yeah, it is a real prospect, particularly as we look forward to the inflation reads coming this week. But away from the data, will equity markets continue to take, bad news as good news, as we've talked about so many times in the past?
It definitely seems that way at the moment. If you think about historically, September is generally not a great month. So since 1971, actually the markets dropped by 1% on average in September. this September seems to be a little bit different because I think the market wants to focus on the Fed cutting. And that obviously in an environment where you have bond yields now coming down, growth not being too bad, and the expectation of rate cuts, that is a very bullish scenario for equity markets in general, and particularly for the AI trade and that big hyperscalers that's still seeing good earnings growth. If yields are lower, those high growth companies generally do better. And there's still good earnings growth coming through. So the market's preferring to focus on that rather than on all the underlying risks that's still out there as well.
It's pretty incredible. So what you're saying is equity markets could continue this momentum even if we do have a cut, which is an endorsement of weakness in the US economy. What about some of those traditional leverage sectors to interest rate cuts, like real estate?
Yes, so that's definitely one area of the market that will surely benefit from it. If you think about the interest rate outlook now, it's sort of 100% priced in for 25 pips, but the market's expecting 75 pips in total this year and then some more next year. In that environment, sectors like the real estate sector or any company that's sort of exposed to that side of the market are doing very well. So, for example, in our global funds, we have two companies that I would say are pretty geared to that. So the first one is CBRE. That's the world's biggest commercial real estate company. Fantastic growth opportunities and quite a diversified business model as well. And then CRH, that's not a real estate company, that's a building materials company, but very well exposed to the various markets as well if you're going to see a better real estate outlook.
Now, I know that we're very focused on rates right now in the US, but writing the morning note this morning, you can't look past all of the political uncertainty. So from Argentina, Indonesia, Japan, also France now at a real crisis point. There are underlying fundamental problems with France, including growing debt. Do you just steer clear of any companies with exposure to that area?
I wouldn't say we just stay clear, because I think even in a tough environment where you have all the political uncertainties, you can still get sectors that's actually still doing pretty well. At the moment, European banks, for example, is one area where we do have exposure, not necessarily to banks in France, but generally speaking, that sector can continue to do pretty well. Where we do stay clear of is in this environment, for example, in Spain, where they are battling with really high debt, adding on a new, sort of PM coming in, he would probably want to increase taxes or try and get behind this big debt problem that they have. That could impact consumers, and particularly a lot of companies with exposure in France is the luxury space. And that is where we have been exiting our previous luxury exposure that we had in Richemont, and we would want to wait and see how that plays out in a market like France. But generally speaking, I think we prefer to go for those companies that's got a bit more of a broader exposure rather than just being very geared to one country per se.
So we are at the end of quarterly earnings in Europe and in the US. We're at the end of reporting season here in Australia. I guess we enter AGM season here next. Globally, though, I know it's rates, political uncertainty, but what do we know on a company level? What will we next learn on a company level?
So September, is generally speaking, is conference season. So our global team travels hugely. We currently have 3 of the team on the road, and our technology analyst and portfolio manager, Trent Masters, just came back from a big technology trip in the US, attending conferences. So we would very much be driven by the feedback that we're getting from these various conferences. And at the moment, from a technology perspective, there certainly is still a lot of momentum behind it. If you look at deals that's been announced by Broadcom, for example, and OpenAI, that just this week, there's a huge amount of capital still being spent on AI. That's expected to be above 400 billion next year, just by the big 5. So for us, that AI trade is definitely still going. I think it's just time to be quite selective. So we prefer to have sort of exposure to the various different stages of that AI trend. So for example, we like TSMC, that's actually manufacturing those semiconductors. Nvidia is clearly the leader in that space. And then beyond that, we want to ensure that we are getting a more diversified exposure to technology type stocks as well. So for example, software is one area where we have been adding. But I think generally speaking, beyond just technology, if you hear what the conferences are, what key points are from conferences, so industrials, I think the main point that I took away from that is that we haven't really seen the full impact on tariffs just yet. That definitely is still going to come through next year and the year after. And then on the consumer, it's still very a bifurcated market, particularly in the US, where the lower end consumer is still under a lot of pressure. So the dollar store type companies where we are not exposed at the moment. And generally speaking, that upper end consumer is still relatively robust. I think the main point, though, is that from a tariff perspective, a lot of these companies are saying we will probably only hear and see the major impact next year. So to date, consumers are still, sort of taking on a lot of that tariff exposure. But from next year onwards, it will be, I think, coming through in prices even more, so demand will potentially be impacted.
So can I ask, have you been very active at Alphinity? Have you been making additions or detractions from the portfolio?
Yeah, this year has been a very active year for us in general. I mean, we are style agnostic, so we don't really mind if a stock is a cyclical or defensive or growth or value. We focus on the bottom-up earnings outlook for each company, and we're looking for those companies that can surprise on earnings. So in an environment where you have so many different style switches, normally you would expect our portfolios to be quite active. So some of the names that we've recently added would be quite diversified, but Viva, for example, is a software business focused specifically on that sort of more life sciences side, so a database, cloud-based business, which is interesting and a bit more defensive. And then we've also added something like O'Reilly Auto Parts, which is sitting on the consumer side, but quite a defensive growth company. So for us, this is a time where we want to be pretty balanced. So we do have those big, good defensives like Coca-Cola and Costco, but then also we have our AI plays, as I've mentioned, but then also more of that sort of defensive type businesses like an O'Reilly, that's not necessarily 100% geared to the market. That's a bit of a lower beta and giving you that sort of more smoother outlook and performance, which is what we're trying to go for.
So that was Alphinity there speaking about global opportunities. You can catch that online shortly if you'd like to listen again. Just before we go, let's check in on where we're expecting this day to start locally, down by 31 points, adding to yesterday's losses. We'll be watching the gold stocks, though, after gold hit yet another record high. News Corp as well in the wake of the succession resolution, so to speak, when it comes to Fox and News Corp. There's plenty to come. Stick around.